Welcome everyone to my channel. If you are new here, I like to share all kinds of information that I've learned in life. I do reviews, I do technical topics in the IT field, and then I do videos on personal finance. In this specific series, I'm actually covering the wheel strategy and the Roth IRA. So if you've ever heard of options, the wheel strategy is one of many strategies to use with options. There's not a lot of people that have documented utilizing the strategy with the Roth IRA. So I kind of wanted to go through and demonstrate what it looks like and if it's a good idea or not. I'll probably be doing this for 6 to 12 months. This is the second video in the series. It's episode 2. So if you want to go back and see the first episode, I'll leave the link to that in the description down below. So quick disclaimer, this is not financial advice. Do not take this as instructions to follow. I'm sharing my personal experiences and viewpoints. You should always consult with a tax professional, and you should consult with a certified financial planner, preferably a fee-based one, before doing any kind of activity like this. I do have a few requests. If you do find this useful in any way, please like the video. If you think it might be useful to others, please share it on Facebook or Instagram or Twitter, anything you feel like sharing. That helps out my channel a lot, and it helps other people out as well. For future videos, ensure to subscribe and click the bell icon so you'll get notified. If you'd like me to delve into any of the topics that I'm talking about, please comment down below and I'll take a look at them, and if there's enough interest, I'll do a video on that. It's just way too much to cover all the specifics of options. There's plenty of channels out there, but I'm more than happy to do a video if there's something someone has a question, or if it's a simple question, just ask in the comments and I'll answer it down below. Also, if you've done this activity before, if you've done a wheel strategy in your Roth IRA, I would like to hear about your experiences, if it went well for you, if you use the wheel strategy in general, what your thoughts are, how it went for you, any questions or anything you'd like to share. It helps out everybody. So some topics for this episode: I'll be reviewing the activity I've done since the last video. I'll talk about my thoughts on what occurred. We'll talk about worst case scenarios. I think that's kind of important to cover. I didn't do that in my last video. So I kind of want to go over, hey, what's the worst thing that could happen? I'll discuss some pros and cons. I didn't do that last episode, so I figured I'd spend a few minutes doing that. All right, so let's go over the trades that occurred and the activity that's occurred since the last session. So for that, I'm going to bring up my browser. So after the last episode, I actually had just sold, I believe the put went through, the stocks were then in my account. So on that Monday, I actually did a covered call. So I'm doing P for put, C for calls. I did a strike price of 360. As I said in the last video, I wanted about a 30% delta. So at the time when I did it, it was around 30% delta. And delta, we kind of look at it as the percentage chance that it's going to go through. So 30% means there's a 30% chance that it will be at or above the strike price of 360. For doing it at the time when I submitted it, I had a premium of 4.5. So this varies a lot through the day. I ended up, I think in the video, I was trying for 4.6 or something close to that, but when I actually submitted it was at 4.5. So I got 4.5, that's per share. And then this is one contract. One contract is 100 shares. So you multiply the 4.5 times 100. And then this is after there's a fee involved for my brokerage. So this is after that fee is involved. So I got $448.98 deposited to my Vanguard account, which brings the total that I've made since I started this process $1,059.97. That's from the puts that I did before and then this final covered call. So I'm pretty happy with that. I probably could have done a little bit better if I did the timing better, but it's hard to get the timing. But I'm pretty happy with $448. That's fine. The other thing I want to talk about real quick is that this VOO price has fluctuated quite a bit, especially after the interest rates were raised. So since I've done this, it did go pretty close to 360 a couple of times. My goal for this is to try and hold on to it as long as possible. It's okay if it goes over 360 as long as it doesn't hit 360 by the expiration date, which is on the 18th. It's less than 360. I should be good. Now people can actually submit to get it exercised before that point if it's above 360. So let's say on Monday it bumps up to 365. Somebody could exercise on it. It's just not very likely. Most of the time people are going to wait because it's in their interest to let it go to 370 or 380. They should try and hold out as long as possible because they want to get as good of a return as possible on their side of this equation. So I wasn't too worried here. It's 360. If I could go back, I might have done a little bit lower delta just to make sure that I don't get exercised on. This one, it got a little bit close. Just to talk about some of the things that I could do is I could roll it out. It would cost me a little bit of money, but basically I could make my strike price 365 or 370, or I could push the expiration date out to December if I wanted to. This is a monthly option. So with weekly options, you can do it, do just a week or two extension, but with this one, it has to be a month. I'm going to try to avoid that. Just keep it simple and try to make just a little bit of money. Next month, I might do like a 20% delta so that I'm way less likely to have it exercised done. But I haven't gone over 360, so I might be fine. We'll just have to see how it plays out over the next several days. And also, of course, on the 18th, that's when it really matters, is what the price is on the 18th. The other thing I do want to mention real quick is that if there's an ex-dividend date, which means that's when you have to have the shares in order to get the dividend, if that date were coming up before the 18th, I might get exercised early on. If it's over, it has to be over the 360. So that's another thing to keep in mind, but it doesn't go ex-dividend until December, so I'm okay on that right now. So I didn't talk about worst case scenarios last time. I kind of wanted to delve into that. The first one we need to discuss is underlying goes to the moon. I say underlying because all options, they have an underlying item. It's either a stock, an index, an ETF. There's something that contract, and for futures and stuff, it's like corn, oil, etc., etc. For all these contracts, there's something that it's referencing. So in this case, what I mean is that VOO goes up a whole lot. That's one of the worst case scenarios. The next one is the underlying goes to $250 a share. And we were talking about a strike price of 360. I bought it at 345. So if it were to drop down to 250, that's a huge impact to the stock. So I'll talk about that a little bit. And then the third thing that could happen is the underlying could go to zero. It could be null and void. I have had that happen with stocks before. It could go down to like penny shares. It could be delisted. So essentially it goes to zero. So I'll talk about those scenarios. If there's another worst case scenario someone's aware of that I haven't covered, please comment down below. I believe these would be the only ones we would see as one of these three options. So let's talk about the underlying going to the moon. I purchased 100 shares of VO at 345 on 10/21. It cost $34,500. So the strike was sold at 360. This is kind of what it looks like. You have the underlying item, which is VO. In this case, it's an ETF. The date is written in different formats. This one is the year 2022, and then 11 is November, and then 18. So this is for November 18th, 2022. That's when the expiration date is. It's a call, and then the strike price is 360. Assuming it goes to the moon, hypothetically, on November 18th, let's say the stock price goes up to $400 a share, and we'll get exercised at 360. So this is what I'm getting paid for, is someone can buy those shares from me at 360 no matter what the actual stock price is. So in this scenario, S&P went crazy, S&P 500 went crazy, it went up to $400 a share. Because I have a covered call on this, I have to sell this at $360 a share. That can be seen two different ways. One way is, hey, I'm going to get 360, which I bought it at 345, so I'm still going to make a profit no matter what. The con of this, the underlying going to the moon, is that I'm missing out on that difference, and I'll show the math for that next. So if we had sold it at 400 a share instead of 360, we would have made a profit of 5,500, but we have to sell it at 360, so that's 36,000 minus 34,500, which is what we paid, so that's only 1,500. But we also have the premium, right? No matter what, you get the premium, so we have to add that to it, which is $1,948.99, and that's a delta of $3,551. So if it went up to $400, if I had sold it at 400 without the covered call, I would have made $3,551 more dollars than doing it this process. That is one of the major cons. People see it as, losing that money. I kind of want to talk about this though, things to keep in mind with that. If the stock price doesn't go over 360 by the expiration date, we still make that premium. We still make the $448.99. If it does go up to 400, we still keep that premium, but we don't know that it's going to go up to $400 a share. There's no way to know that for sure, but we know we get $448.99. So that's the huge advantage in this situation, is even though we are quote unquote losing out if it went up to $400 a share, we still get this premium no matter what. Even if it doesn't go up, if it goes down to $300 a share, we still keep this premium, which is awesome. Now the second scenario is, what if the underlying goes to 250? So we bought it at 345. What if it goes to 250? So that was a cost of 34,500. The strike price was 360, and then the stock price goes to 250. So this is bad because we have to choose between either, with the whale strategy, you would just keep doing covered calls, right? If it doesn't exercise, we normally would do another covered call to get another $400 or $500 or whatever. But now that the underlying's at 250, we keep the premium before, but now we have to make a choice of either not selling covered calls, which is probably what I would do in this scenario, or selling a covered call with a very low delta. But that's very risky because you are making some profit, but you have a high chance of it rebounding and then you actually selling the stock below your cost basis. And the cost basis is what we paid for it, right? So starting out, the cost basis for us was $345 a share. And then as you do these covered calls, it does lower that slowly over time. But if, like this first time up, it goes to 250, we didn't make that much. Our cost basis is a little bit lower than 345 a share, but it's still nowhere near 250. In this scenario, I probably wouldn't be selling any covered calls until it went back up. If you watch other YouTubers, this is typically referred to as bag holding, because basically you have to hold onto this. You're not able to make any profits off the covered calls until it returns. So some important things to note about this is you should only have an underlying stock, ETF, whatever you're doing your covered call on, with something you're okay keeping for the long term. So if there's a drawback, if the stock goes down, the whole market goes down, you're okay still holding onto those 100 shares no matter what. In this case, it's VOO, so no duh. I'm definitely happy holding onto VOO. You could do other underlyings. You could do individual stocks. You could do, and I'm just throwing some stuff out, Ford, General Motors, General Electric, Amazon, any of those you could do this on, but those are way more volatile. It would be something you want to make sure you want to hold on to. It could be very risky being an individual stock, but the VOO as an ETF, I'm not concerned about that. You would still have to deal with this even if you weren't doing the covered call, the whale strategy with options. If you bought a mutual fund or you bought an ETF, it's still going to go down in value. You're not doing covered calls on it. So the only thing this really impacts is your ability to continue doing the covered calls, but the stock price being down can happen no matter what. One thing to keep in mind, as long as it's a good investment for the underlying, then it should return either months or years later. With VOO, it's the market, so eventually it is going to recover. It could be months or it could be a year, 18 months, something like that, but it will recover. It just takes time. I do want to state that you wouldn't want to buy something that had a high premium. The more risky and volatile stocks and underlyings are going to give a higher premium, but they're also way more likely to drop in price a lot, and then you wouldn't be getting the covered calls going forward. One of the YouTubers I watch, he got Peloton whenever it was up high, and then I think it was over $100 a share when he started, and now it's like $6 a share, so that's a huge loss. I don't see VOO dropping down to $6 a share. If it does, we got bigger problems. So TLDR of this is, don't buy something just for a high premium. Make sure it's something you're okay holding for the long term, and that's something that's likely to go back up in value. And the absolute worst case is that the underlying goes to zero. So again, we spent 34,500, 360. There's several things that can cause this. A stock can go null and void. I had that happen to me where basically the company that owns it considers their stock worth nothing. and poof, the money's all gone. So hypothetically, the stock goes to zero, it's delisted. This can happen with stocks anyways. This is not something specific to options. Still a bad situation. We still keep the premium though, so that's an advantage to doing this with an option. Is if you just bought a stock, bought an ETF, bought a mutual fund, and it went to zero, you would have nothing to show for it if it went to zero. Where in this case, if you did a covered call, you at least got some premium money out of it. Not a lot, but you got some. If you can keep doing it, you can get a lot of premium out of it. And again, it's not something unique to options. Any stocks can have that happen. All right, so I want to talk about pros of doing the wheel strategy with a Roth IRA account. Again, this is specifically for a Roth IRA account. So you can have additional income when you do those cash secure puts and the covered calls. You get that premium, so that's additional money that comes in, and then that money can be invested, so then you get gains on those gains. So due to compounding, you're going to have an exponential increase in your investments. Again, specifically with the Roth IRA, it also takes advantage. You've already paid the taxes on it, so any of the premiums you get, any of the capital gains you get, you don't have to pay any taxes on any of that. So that's a huge benefit to doing this in a Roth IRA account. In a taxable or traditional IRA or 401k, you would have to pay taxes on the premium and you would pay taxes on the capital gains. But with the Roth, that's specifically what makes it so good, is that you don't have any taxes on it. So let's talk about cons. So you need to learn about options. It does take time to do that. There are certain terms you should know before you do this. You need to know things like implied volatility. You need to know premiums. You need to know how to submit a put and a call. So there's some time you'll have to spend initially to learn about all of that. The reason I'm doing this video is to give you why you may want to spend that time and how it would work. This is my first time doing it. I haven't seen a lot of people do this in a Roth IRAs. Part of this is me just seeing if it works or not. Just know that before you do this, you'd want to put a lot of time into learning about the wheel strategy and options. It does require a little bit more time to track and monitor. I no longer put money into my IRA. My 401k is building up, but I'm not adding any more into my IRA, so I don't have to touch it other than probably once every 6 months to a year. I do rebalance my IRA, but this requires a little bit more time, once a month basically, to track and monitor it. If I didn't want to get exercise done, it might be a little bit more time. If I wanted to roll the covered call or the cash secure put, that requires a little bit more time. Not significant. I would say 2 hours a month, maybe 3. Not a lot of time, but it does require some amount of time to track and monitor and submit and make sure everything goes through. There are fees for most of your applications, your brokerages out there, so you need to know what those are. For me, Vanguard charges $1, but different companies, I say $1 today, who knows in the future, but your brokerage may charge something different, so you need to be aware of those fees. Every time you trade that contract, you're paying that. Then there's also the additional stress from bag holding. So if you did have something and you couldn't do covered calls, or if you decide to be risky and get a little bit of premium, you would be stressing out about getting exercise done below your cost basis and losing out on money. With the index funds that I invest in, I just put that money in. I don't think about it at all. But with this, I do have that in the back of my mind of, do I need to keep an eye on it? Do I want to roll that covered call? So that is some additional stress from bag holding if that does happen, or getting exercise done. If you're emotionally attached to your underlying stock, your ETF, whatever the underlying is, that's something else to deal with. And until you've actually done this, you don't know that impact. But it did impact me when I first started doing this. I did have that emotional attachment to those underlyings. Something to be aware of. So what I've covered this episode is I've talked about the activity, my thoughts on what occurred. I discussed worst case scenarios. I discussed the pros, the cons, and I want to thank you for listening. If you liked the video, please like and subscribe. That way you can get future notifications. I'm open to feedback, so if there's anything you liked or didn't like, please let me know. And if there's anything you'd like me to cover in future videos, let me know. If you have utilized the wheel in a Roth IRA before, please let me know how that worked for you, or if you just did covered calls or just did cash secure puts in your Roth IRA, I definitely want to know about that. Or even the wheel in general, if you've been doing the wheel for a while in a taxable account, share your experiences so other people can learn from that. And any questions, let me know. Thanks for listening and have a great day.